Are you guys ready for some more bad news? Because that's all I seem to be giving out these days. But this time I'm kind of just the messenger because this bad news is coming from Stan Druckenmiller. And you guys know Druck, the famous market wizard, the GOAT of investing, really. This is his bear market face. He's ready. The man loves bear markets because he makes the most money in them. But he just had an interview at the recent Sohn conference and he said a lot of interesting things, of course. And he's really been the best at macro for 30 years now, even more than 30 years. But in this video, we're going to go over some of the highlights of what he said so we could see where this market is headed. And fortunately, this JSC Capital has a good review for us on Twitter. So Druck has been talking about inflation since last year. But right now, there's three things that are really surprising him. Number one is the actual magnitude of this current inflation. That inflation print surprised everyone the other week, right? Well, even Druck is surprised by how much inflation we're getting. The second thing that surprised him is how this bubble is bursting. And this is the bubble we're talking about in the stock market, right? We know so many tech stocks and high flyers are down like 90%. So he said this was a bubble burst with a vengeance. So a lot of good companies are down 60 to 70% without a notable change in fundamentals. So really it's just the valuations being reset. And we've talked about that before in previous videos, right? The difference between this current tech bubble and the one in 99 and 2000. So the difference here is that a lot of these companies are actually growing their revenues. They're actually doing well fundamentally versus back in the tech bubble, the fundamentals were garbage. They looked pretty bad. So it is different. Like Druck says, there is no change in fundamentals. So really what's happening is just valuations are getting reset hard. And even as I'm recording this is a pre-market Thursday. The NASDAQ is down another, 2.5%, 2.4. The little rally that we had off the Fed meeting is getting reversed. In the S&P, it looks like we're hitting new lows again. It's brutal, so these stocks will keep getting hit. Now, the third thing that surprised Druck was how slow the Fed was to recognize the problem. So he thought they were slow in April of 21 last year, but in March of this year, they were still buying bonds. And they didn't even pivot verbally until last November. So in his 45 years as a chief investment officer, he's never seen a combination where there's no historical precedent like the one we're in right now. And we talked about that in the last video. No one knows what's going to happen with inflation now or where the market is going to go. Now, normally no one knows everything, but here it's even more so because there is no historical analog. There's nothing to look back on in the past like, oh, this has been a similar situation to this. It's just never happened before, which is indeed a little scary, but that's the theme of this video, right? Bad news, scary news. And I say it in this positive and upbeat voice because what am I going to do? Cry on camera? Of course not, because we got some solutions too, which we'll talk about in a second. So he's never seen a historical precedent to where we are now, because inflation is at 8% and we're going into a weakening economy with bond yields at 3%. So he's feeling like he's about to play a round of golf without a driver or a 60-degree wedge. So the way he's made money over the last 6 to 8 months was by shorting fixed income and stocks. He's also been owning oil and mistakenly gold and copper. But things are much harder right now, so he's just waiting on his hands for a fat pitch. But at some point, he anticipates getting back to short equities and eventually the US dollar. And you guys remember what he was saying from the last video. He said he's coming in every day and looking at the screen, but he's pretty much taking a break and he's waiting for that fat pitch. He wants to be fresh. It's been a lot of activity in the last 4 to 5 months, so he's in no hurry here. He's in the marathon and he's not running full out on mile 16. And that's what you have to do in situations like this where it's so unclear as well. You don't want to force it, because if you force it, you're just going to lose. He owns energy and other commodities right now, and Ukraine has given the trade an extended life. But he thinks the world is short energy over the next 5 to 10 years due to ESG pressures, which means the trade has legs. And I think what he means by short energy is like short on energy, meaning long energy and commodities has legs. So next up, he was asked about Bitcoin and crypto and the potential ripple effects in the economy. Because as we also said in the last video, Bitcoin, Ethereum, they are going to be dead money for years. And the correction that's happening, it's just getting started. So Druck said you can't just build $2 trillion in wealth and purchasing power, which was done with crypto, and then destroy half of it and then have it not matter. Meaning it will have some effect because a lot of money is built up there. So he sees a high correlation between Bitcoin and the NASDAQ right now and looks at it as an indicator. And he's sympathetic with what both Charlie Munger and Bill Miller say about Bitcoin. So, Charlie Munger thinks Bitcoin is absolutely stupid and Bill Miller has like half his fortune in it. So Druck here kind of sees both sides. But he says there's definitely a strong overlap between NASDAQ risk players and Bitcoin owners. And then of course the people that are gold bugs and want the world to fall apart. He said there's no question if you believe we're going to have irresponsible monetary policy and inflation going forward, that if it's in a bull phase, you want to own Bitcoin. But if it's in a bear phase, then you want to own gold. He also said he'd be shocked if blockchain isn't a force 5 to 10 years from now. His advice to a 20-year-old tech investor would be to spend as much time in that space as possible, similar to the internet and cloud. So that kind of matches with what we've always said about Bitcoin. Actually, trading these cryptos, it's very speculative. So it can go up, it can go down, and you can see right now how bad it's going down. But it is just air. They could be valued at anything. But long term, the actual underlying technology of blockchain, we feel like that's the important part. So if you do want to hold Bitcoin or Ethereum long term, I would say do it with a very small portion of your portfolio. Currently in the Macros portfolio, we're short Ethereum, and we've been making good gains on that, while the rest of our portfolio is in cash. We're like in 80 to 90% cash right now with a few selective shorts. And we'll talk more about that in a second. So Druck also highlighted two historical facts that have an undefeated track record. The first one is that once inflation is over 5%, it never came down until the Fed funds rate got greater than CPI. And the second is that once inflation is above 5%, it's never been tamed without a recession. So he thinks the first historical fact will be violated, but he thinks a recession is coming. And he highlighted that the Fed has orchestrated just 2 to 3 soft landings historically, the notable one being in 94 and 95, but with the Fed funds rate just at 75 bips right now, and it's a little higher after the raise, and projections at 2 to 3% versus inflation at 8.6%, we are so far behind taming that inflation with so much wood to chop that on the back of such a large asset bubble going into it, the probabilities support a hard landing. So rates gotta raise a lot, and we're in this big asset bubble, and when you're raising rates with a big asset bubble, you're gonna get a hard landing. We have $1.5 to $2 trillion of excess savings, and it may be time to work through that. But given the asset bubble and subsequent market destruction that's happening right now, and Ukraine and the zero COVID policy in China, he sees a recession in 2023. He just doesn't know if it's going to come early or late. Now, when asked about his ability to use market internals to predict the economy, he says right now you have home builders down 50% on good fundamentals, trucking stocks down 40% on record high earnings, and retail, which isn't much of a leader but more leader than laggard, they're down too, even once you adjust for COVID normalization. Now, these tend to have longer lead times, so he doesn't expect a recession tomorrow, but he does expect one within the next 6 to 12 months. Another thing he talked about is his philosophy of putting all his eggs in one basket, watching it closely, and developing conviction 1 to 4 times a year. And you guys know the famous investing quotes like, don't diversify, put all your eggs in one basket and watch that basket very closely. He thinks investors get in trouble by being diversified with stale longs or shorts. If he has 15 to 20% or in macro 200 to 300% of his assets in a single position, then they're never stale. That forces him to have ruthless discipline and to be constantly paranoid, always reevaluating and being open-minded. It's just kind of funny because what he's saying is the more size that I have on, the more I'm going to pay attention to it. It won't be boring. Now, this is arguably the greatest investor of all time saying this, so take it with a grain of salt when you apply it to your own process. His number one lesson from Soros is that sizing is 70 to 80% of the equation. And I'll tell you what, position sizing is the hardest part of the game too. Because here's another famous Druck quote coming. It's not whether you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong. Actually, I think that's the Soros quote. But when we talk about risk management, position sizing falls into that too. You want to have a small enough position so that when you have to cut your loss, you're not getting blown out. And you know, in the macro ops portfolio, the way we size into a position is we usually have a starter position and then we add on as it goes our way. That's another way to control risk. And that's another way to build up a big position over time. Because you don't necessarily want to put on 70% of your capital all at once, because what if you're wrong? Even if you do cut your loss, you're going to lose a lot. So that's why you stagger in, depending on the strategy. And he says it's not whether you're right or wrong or how much you make when you are right, because a lot of these guys have 30% hit rates? These guys will be wrong a lot. And these are the best guys, right? And you're wrong 70% of the time? Well, it doesn't matter if you're wrong that much if you only lose a little bit. And then on the times you're right, when you make a ton, it's going to cover all your losses plus more. That's why when you're right, you really got to size up if you're in a discretionary strategy, and mostly in macro, I'd say. This isn't the same as systems trading, what he's talking about. As an investor, he believes in streaks, so he needs to have an investment that excites him and that he sees himself trading well. So he said the number one piece of advice he got from his original mentor was focusing on what makes stocks move. Why will people think differently 18 to 24 months from now than they do today? So don't invest in the present. The present doesn't move stock prices. Change is what moves them. So imagine a different world in 18 months from now and where these security prices would trade given the world that you envision. And that's kind of what we do do in macro ops, right? We look at the different scenarios and try to build a vision of what could happen and then play it based off that. And then that's why you got to stay fallible, because that vision is going to constantly change based off the new information coming into the picture. So you got to be open-minded and you got to change with what's happening. You got to go with the flow, which is going to be my theme going forward. Not just in the market, but in life too. But I'm not going to rant about that right now. Druck also gave a rundown of his famous tech bubble story when he shorted 200 million in March 99 and lost 600 million in 4 weeks. And he was down 18% for the first time in his life. But this is what going with the flow is, and this is some mental fortitude right here. He flipped to go long and finished up 42% for the year. He once put on 6 billion of longs hours away from the top and lost 2 to 3 billion in weeks and was down 18% again. Then he took 5 months off and came back shorting and was up 40% by the fourth quarter. So he's doing some nutty swings, and that takes a lot of mental fortitude. He also talked about how he likes to invest and then investigate, because given the competitive dynamics in the business over the last 20 years with even more information and people, you don't have the time that you used to when you hear a good idea. If you wait 2 to 3 weeks trying to do your research, 60 to 70% of the move could occur. And maybe it's not a long-term move, but the entry price is important. And it's important psychologically as you add over time. So you don't have time to do a deep dive analysis. If you have intuition, you buy it and then do analysis and double down or cut it, as opposed to waiting and then doing the analysis. Again, this is for discretionary trading and when you're really good. So in the macro ops portfolio, we do often do this, and that's what I was talking about with starter positions. If something looks good and Alex and Brandon have a feeling about it, they put on a small position. That way they're not missing the move, because as soon as you get that feeling, it could take off. And then you go and do the deep dive research, and as you get more conviction, you keep adding more. And you keep adding more as the position moves in your favor. Now, what am I talking about when I say intuition? Well, to develop an actual good intuition, you got to be at a certain level in the market. And in our macro ops team, we've been doing it long enough that when we have that intuition, we can go with it. But that's why I say it's dangerous to listen to this advice when you don't have that experience and that intuition built up. Because you might go with it, and what's going to happen, you're going to lose a bunch of money. So that's why when we talk about systems trading so much, it's different. You basically ignore your intuition because you follow your system. Because oftentimes what happens, your intuition is wrong. You say, no, I can't get into the market right here. It's about to crash. And then what happens? You don't get in and the market takes off without you. So it's a delicate balance when we talk about these things. Because even when I'm saying follow your intuition in discretionary trading, there's still a process to discretionary trading. And it's all just very nuanced about when you break the rules and when you don't. And that's what gets complicated, because it's more of an art form than just a drill down process. That's how discretionary trading works. Systems trading, yeah, it's a process. It's all back tested and you have the numbers. Discretionary, not so much. So Druck told a story of a Lehman analyst coming in who laid out the whole subprime thesis, that by third quarter 07, all hell would break loose. So in the next 2 days, Druck shorted everything in housing, and he was wrong for 6 months. But the analysis was consistent, and the deeper he dug, the more confident he got. So he put on that smaller position and was wrong for a long time, but was eventually right. So Druck says where we are now is extremely hard to predict. What the central banks did globally over these last 10 to 11 years leaves him open-minded to something really bad happening. So he's thinking a 1930s post-asset bubble and horrible recession. Do they get stagflation or deflation? Japan is still suffering from 1989. So we could have no growth in sideways markets for 15 to 20 years, like we did from 66 to 82, or something similar to Japan. But that being said, Druck knows he has a very bearish bias. And he knows he has to manage that every day, so he tries to keep an open mind to probabilistic changes in what's happening. And that's the thing with all macro guys, Druck, all of them, even Alex, they're all skewed more bearish normally. But they all try to fight that, because to be a good investor, you got to be completely open-minded. And we've talked about sideways markets before. When you zoom out on the picture, you'll see that for decades, the market doesn't actually hit new highs. But within that period, you're going to have big swings up and big swings down. So systems still work. The only time they struggle, depending on the system, is when there is a ton of volatility. So you're not even getting the proper swing up and the proper swing down. It's just up and down like that. And in those markets, when you're a really short-term trader, like our partner in macro ops, Tyler, he does really well in those markets because he's so short term. But if we go into multiple decades sideways markets, the guys who are going to get hurt are those buy and hold investors. If you have a system though, you should do well, because you're going to make a lot of money on the upswings and protect your risk on the downswings. So you'll beat the market by a lot. But at this point, given the environment that we're about to move in for the next 10 to 20 years, macro is really going to come to the forefront. And macro has been dead for a long time. The last decade, everyone laughed at macro people because the whole gospel was just buy and hold, just keep buying. The market only goes up, buy the dip. Now, finally, that's changing. This is when risk control comes into play. This is when good macro bets come into play. And this is where it's going to really pay off to play more markets than just equities. Commodities are huge in an inflationary environment. That's where we made a ton of money this year. And that money is being made in the macro ops portfolio. We're currently up 20% right now. Compare that to the NASDAQ, which is down 30%. That's a 50% difference. And that's why as we're making this transition into these new markets, we want everyone to join the Macro Ops Collective. So what is the Macro Ops Collective? Well, if you've been watching these videos, you know all our research comes from macro ops, and a lot of that is our premium research. So the guys in the collective are getting that right away, and they get a lot more than I actually talk about on the channel. We have a number of analysts on the team pumping out the information that we use to trade. That's why we're up 20%. But not only do we have that, but we have a lot of training involved too. So what we're working on now is a full macro course to teach everyone how to trade these markets going forward. And a lot of that information is already in the collect itself, and we're constantly adding more. So it's research, training, and it's one more thing too, it's community. We have a private Slack channel called the Comm Center where all our people go each day and talk shop. And the people in that community range from college kids and grad students that are really smart to veterans in the game who are managing hundreds of millions to even billions of dollars. So it's a very valuable group to be in because we get a lot of intel right there too, because it's kind of a global network. We have guys all over the world. But anyway, now is a great time to join up. You could go to this page and learn more. We're closing down enrollment tonight, so definitely go check it out now. We would love you to be part of the group. I'll put a link down below and hopefully in this video too. But definitely check that out, and once you do, make sure you watch our last video too. We talk about the feedback loop that's happening in the market right now that is really crushing stocks. So you're gonna see why that's happening and what needs to change for the market to stop falling. So check out the collective and then click this video right here, and I will see you there.